In the last 47 days, we have witnessed a statistical anomaly in the global markets. 37.6 million ounces of silver simply vanished. It was drained from the COMEX vaults at a speed not seen since 1980. You might remember 1980. That was the year silver hit $49 an ounce and the futures market nearly collapsed. But the data suggests this time is fundamentally different. In 1980, it was speculation. Today, it appears to be a supply freeze. On February 14, 2025, reports surfaced that 4 major South Korean banks suspended sales of physical silver bars indefinitely. Simultaneously, China has implemented new restrictions on retail precious metal purchases. And right now, a rare phenomenon is occurring in the charts. Spot silver is trading higher than futures prices. This is known as backwardation. In economic theory, backwardation only happens when the market values immediate possession of a commodity far higher than a promise of future delivery. It is a sign of extreme physical tightness. We appear to be entering stage 3 of a 4-stage market pattern. Stage 1 was stability, stage 2 was leverage, stage 3 is the squeeze, and stage 4, that is the break event, when the physical price decouples from the paper price entirely. I have spent the last week analyzing the COMEX data, the vault withdrawals, and the industrial deficits. The math suggests that the window of availability is narrowing. By the end of this video, you will understand the historical precedent for this event, the industrial supply crunch driven by green energy, and the mechanics of what happens when a derivatives market confronts a physical shortage. This is not a sales pitch. This is a market autopsy. Let's look at the data. To understand the mechanics of a silver squeeze, we have to look at the most famous case study in financial history, the Hunt brothers. The year was 1979. 2 Texas oil billionaires, Nelson Bunker Hunt and William Herbert Hunt, began accumulating massive positions in silver. Their thesis was simple. They believed inflation was eroding the purchasing power of the dollar and that silver was undervalued. They accumulated approximately 200 million ounces. Half was physical metal, the other half was futures contracts. The impact on the price was undeniable. In January 1979, silver was trading at $6. By January 1980, it hit $49.45. That is a 724% increase in 12 months. But the Hunts ran into a systemic problem known as counterparty risk. They demanded delivery of their futures contracts. They wanted the metal. The exchange, the COMEX, faced a crisis. If the Hunts took delivery of that much silver, there wouldn't be enough left for industrial users or other traders. So, the rules were changed. On January 7, 1980, the exchange implemented Silver Rule 7, which prohibited the opening of new purchase orders. Traders could only sell. When you remove the buyers from a market, the price collapses. The Hunts were margin called and eventually bankrupted. However, there is a critical lesson here for students of market history. While the leverage destroyed the Hunts, the physical asset retained significant value relative to its starting point. Even after the crash, silver settled around $10 an ounce. That was still 66% higher than where it started before the mania began. The lesson is about the difference between paper price and physical value. The paper market is a tool for hedging and speculation. It is highly sensitive to rule changes and margin requirements. The physical market is driven by supply and demand. Today, we are seeing signs that the paper market is under stress again, but this time, the pressure isn't coming from 2 billionaires. It is coming from industry. Silver occupies a unique position in the global economy. It is a monetary metal, like gold, but it is also an industrial necessity. It has the highest electrical conductivity of any element. This makes it essential for modern electronics, smartphones, EVs, solar panels, and 5G infrastructure. The structural problem the market faces today is a persistent deficit. We are mining less silver, but consumption is rising. In 2024, the global silver deficit reached 148.9 million ounces. This marked the 4th consecutive year where demand outstripped supply. A study by the University of New South Wales highlighted the scale of this demand. It projected that by 2050, the solar photovoltaic industry alone could consume 85% to 98% of global silver reserves. This creates a floor on demand that did not exist in 1980. Back then, silver was mostly used for photography and jewelry. Today, it is used for energy transition. This deficit is draining the stockpiles. On October 1st, 2024, the COMEX registered category, silver that is warranted and available for immediate delivery, stood at roughly 80 million ounces. By December 2025, that number had dropped to 43 million ounces. That is nearly a 50% reduction in available inventory in just over a year. In a balanced market, price rises to destroy demand, but industrial demand is inelastic. Apple cannot simply stop buying silver for iPhones because the price goes up $5. They need the metal. This inelasticity is what creates the potential for a squeeze. When supply gets tight, smart money moves first. We are seeing several signals indicating that institutional access to silver is becoming restricted. Signal 1, the Asian banking freeze. The reports of South Korean banks suspending silver sales suggest a sourcing issue. In Asia, banks are a primary conduit for retail gold and silver. A suspension usually indicates that the wholesale market is unable to fill orders at the current spot price. Signal 2, strategic reserves. China and India have been net importers of silver for years. Recent policy changes in China restricting retail access could be interpreted as a move to prioritize state or industrial accumulation over private ownership. When a government tightens control over a commodity, it often signals they view it as a strategic asset. Signal 3, backwardation. This is the most technical, but perhaps the most important signal. Futures markets usually trade in contango, where future prices are higher than today's price to account for storage and interest. When the market flips to backwardation, where today's price is higher, it implies a shortage. Traders are paying a premium to get the metal now rather than waiting. We have seen this pattern before in palladium, 2001, and nickel, 2022, right before major price reevaluations. It suggests that the trust in the delivery mechanism of the futures market is eroding. Buyers want possession, not promises. So, what does stage 4 look like in this theoretical framework? It involves the decoupling of the paper price, spot, and the physical price, street. In a severe shortage, the spot price set by futures contracts may not reflect the reality of obtaining actual metal. We saw a preview of this in 2020 during the lockdowns. The spot price of silver crashed, but physical premiums skyrocketed. You could see silver at $14 on the chart, but dealers were charging $25. The mechanism of decoupling rising premiums. The cost over spot price increases as dealers struggle to restock. Delivery delays. Mints and refiners develop backlogs of weeks or months. Force majeure. Exchanges may settle contracts in cash rather than metal if inventory hits zero. If this happens, the price of silver becomes a two-tier system. There is the price you see on CNBC, and then there is the price you pay to actually hold the bar in your hand. Historically, during currency crises or supply shocks, the physical price becomes the only one that matters for wealth preservation. Adjusting for inflation using the CPI, the 1980 high of 50 would be roughly 170 in today's purchasing power. This gives us a historical reference point for where prices could go if the market were to retest those highs in real terms. I am not here to tell you to buy silver. My job is to explain the risks and the data so you can make your own decisions. However, for those who do choose to allocate a portion of their portfolio to precious metals, there are 4 historical principles to consider. Principle number 1, elimination of counterparty risk. The entire point of owning physical metals, for many investors, is to own an asset that is not someone else's liability. ETFs and unallocated accounts rely on a custodian. If the system stresses, those contracts can be settled in cash. If you can't hold it, you don't own it, is the mantra of the physical investor. Possession eliminates the risk of default. Principle number 2, liquidity and recognition. Not all silver is created equal. Investors typically prefer sovereign minted coins, like American Eagles or Canadian Maples, or recognized bars. Why? Because they are instantly liquid. If a currency crisis occurs, or if prices spike, you want an asset that is universally recognized and easy to sell or trade. Obscure collectibles often lack this liquidity during a crisis. Principle number 3, understanding premiums. The premium is the cost above the spot price. In a tight market, premiums rise. An investor must calculate whether the premium is justified. Sometimes high premiums are a warning sign of a shortage. Other times they are just dealer markups. Monitoring the spread between buy and sell prices is critical. Principle number 4, security and storage. Owning physical assets introduces a risk that stocks do not theft and loss. Professional investors often advocate for a mix of secure home storage for accessibility and private non-bank vaulting for security. Relying on bank safety deposit boxes is often discouraged by the metals community, as access can be restricted during banking holidays or financial emergencies. We are living through a period of historic financial anomaly. Fiat currencies are inflating globally. Central banks are buying gold at record rates, and the industrial demand for silver is colliding with a supply deficit. The data from the vaults is clear. The metal is leaving the system. The banks in Asia are signaling that sourcing is difficult. The futures markets are in backwardation. Whether this leads to a full-blown squeeze or just a structural repricing remains to be seen. But the conditions are set. History shows that when the paper market disconnects from physical reality, reality eventually wins. The only question is how long it takes. The financial system is complex, and silver is just one piece of the puzzle. Subscribe for more data-driven analysis, and I'll see you in the next one.